And for more on that, I want to welcome into the program Joe Lavorgna, counselor to Treasury Secretary Bessent. Joe, thanks so much for joining me. Always great to see you.
Thank you. Thank you.
The Fed yesterday increased their outlook for the economy next year. They now see GDP growth of 2.3%. Fed Chair Powell said that he thinks that any price increases from tariffs could peak in the first quarter. They see inflation falling to 2.5% next year, but the unemployment rate is expected to hold at 4.4%. What's your reaction to that forecast for next year?
We're growing, Jennifer, at 3%. According to the widely followed Atlanta Fed, we were 3.6 last quarter. That follows growth of 3.8% in the second quarter. And when you take the federal side out, because the Secretary Bessent and President Trump want to get rid of wasteful government spending, we find the economy is doing even better. It grew about 4.5% in the second quarter. So we're generating very strong growth. And with the productivity trend we've seen and with tax policies, Trumponomics, if you will, means we should be getting much faster growth. 2.3 is not, I'm happy that I applaud the Feds for revising up their forecast, but those numbers are way too low. I mean, in President Trump's first term, growth was just under 3%. And before the pandemic, it was actually almost 3.5 right before the pandemic. Productivity is much stronger now. The president's policies, they're reinforced from the first go, and they added some extra real important factors like the expensing of factories, overlay that with abundant energy costs, which are pushing prices down to near 5-year lows. And the Trumpian economy should do much better, has been doing much better than 2.3%. Inflation will move lower, Jennifer, and then the unemployment rate will certainly drop. So there's a lot of good things happening, and I feel like there's the optimism is for real, and some of the economists, they are known as a dismal science, and maybe they're proving that a bit.
Well, Joe, just to build on that, I mean, you painted a very robust picture for 2026, and Treasury Secretary Bessent has said that we could see tax refunds of $1,000 to $2,000 per household next year because of the tax bill. That seems to me to stimulate quite a bit of demand, and the Fed has only penciled in one rate cut for next year. Does that seem right to you, where at the same time the president believes that rates should be a lot lower than where they are now, and he believes that the Fed should have cut by much more than they did yesterday?
Well, I mean, President Trump has got a very good instinctive knowledge of how the economy works. And we saw in the first administration when the president was arguing for lower rates that he was correct. We had productivity that was very strong in the first Trump term and very low and stable prices. We're getting even faster productivity now. Inflation rates are going to be trending significantly lower. So I totally understand the president's concerns and frustrations. In financial markets, when you look at things like the slope of the yield curve, what you see is that policy does appear to be restrictive. In other words, not even neutral, but it's actually holding the economy's potential ability back. And the president understands that. He operates in the real world, not the ivory tower world of academia, where many of the economists that work at the Fed perhaps occupy their time. And you could make a very compelling case for rates going down significantly further.
To your point, Joe, the Fed has cut 3 times since September, and you look at the yield on the 10-year Treasury, and it's sitting around 4.1%. Obviously, there's other forces in the markets that perhaps are counteracting what the Fed is doing, but are there any steps the Treasury plans to do to try to bring the yield on the 10-year Treasury down? Because as we know, that affects so many borrowing rates in this economy, particularly mortgage rates.
Well, let me say this, Jennifer, 2 things. Number one, you know, the difference between the Fed funds rate and the 10-year Treasury rate is still very narrow. And that's because the funds rate is high, even by Jay Powell's own admission. Rates aren't even at neutral. What the Treasury can do and what Secretary Bessent has done is put in place policies that will help with the president's vision and leadership of restoring fiscal sanity. I mean, no longer are we going to be running 6.5% budget deficits as a share of GDP in a full employment type economy, which was lunacy. And we're seeing right now significant improvement made in the back half of fiscal year 2025. And the good news is so far in fiscal year 26, which started in October, you've got double-digit gains in revenues year on year, and you've actually got continued declines in outlays. That is a recipe for economic health. And by the way, Jennifer, as you probably know, the U.S. bond market, as Secretary Bessent is rightfully proud of saying, has been the best performing market in the industrialized world. Rates have come down significantly from where they were. And as the administration continues to get the U.S. fiscal house in order, you're going to see those interest rates move lower. And when those interest rates move lower on less inflation, those mortgage rates are going to come down, and we're going to reverse everything that happened under the prior administration when inflation was running rampant and people couldn't buy things because rates were too high.
Switching gears, Joe, Treasury Secretary Bessent has put forth a new letter to make changes to the Financial Stability Oversight Council, a creature left over from the financial crisis. And part of the changes that he is proposing include unwinding some undue burdens, regulations on some of the banking system. What impact do you think that these changes are going to have on financial stability, the financial system, and our economy?
You mentioned creature, Jennifer, which I'm assuming was a pejorative term. The secretary, obviously spending a legendary career in the private sector, knowing how markets work, wants credit to flow freely, wants prudent, sound regulation, which is instrumental in maintaining the faith and confidence in the U.S. financial system, its depth of capital markets, which is unprecedented. But we want to make sure credit goes to the economy, that small businesses gain access to that credit. They're the backbone of growth. And therefore, the secretary is making these changes. They're prudent to get credit flowing more freely and make sure we're not doing things that don't make any sense and hold the economy back from its full potential. We want to get this economy continuing to improve for all everyday Americans and getting those wage rates up, getting growth accelerating, getting that capital spending that the president has helped push into the system, getting that to become as diffuse as possible. And you need the lending mechanism to help us on that score.